you know. Tell you where your head's on.
Economist Peter Schiff warns Fed action could lead to market crashes, massive financial crisis, severe recession. Gold bug. And economist Peter Schiff says there are two possible outcomes of the Federal Reserve's action on the U.S. economy. One outcome leads to a massive financial crisis and severe recession, as stocks, bonds, and real estate crash. In the second outcome, moving on to discuss the second outcome, he wrote, or the Fed pivots before inflation returns to 2%. If the Fed pivots, either to avert a financial crisis, or in reaction to one, inflation will
quite a bull in gold. It's down $25 today. It's at its lowest level in years. What do you say to the people who bought it at $1,700 when you said buy it there? What do you say to the people who, again, bought it at $12.25 when you told them to buy it there? What do you tell them when it's now at $10.50?
Yeah, look, the same thing I've been telling people all along. Remember, I started telling people to buy gold when it was under $300 an ounce. So depending on when you first started listening to me, that depends on, on where your situation is. But I don't tell people to put all their money in gold. I tell people to put some of their money in gold, 5 to 10%. And as you get more money, and if the price of gold comes down, now you can add to it at a better price. I mean, I think my advice to have some of your money in gold is much better than almost everybody else's advice in this industry, which is to have none of your money in gold. And, you could look at history over the last 15 years. The stock market has been cut in half twice. And there are plenty of stocks that people have bought that were highly touted on your network that went down a lot more than the price of gold has gone down from its peak. So it's not
Peter,
that an asset can't go down, especially when so many people are so wrong about what they're perceiving. Remember, in the short run, right, markets are a voting machine. In the long run, it's a weighing machine.
Peter, let's
and
talk
right
about,
now, the votes that everything is
so
great
wrong.
and that the Fed is doing everything right outnumber the votes of the people who know that they've done everything wrong. But in the long run, the
Peter,
price of gold is going to reflect all these mistakes.
Peter, you're doing a great job of filibustering, but let's talk about being so wrong, because when you told people to buy it at $1,700, you said it was on its way to $5,000. That sounds like so wrong to me.
So,
and the problem I've often had with what you said
Scott,
is you make 100 outlandish predictions. 99 of them are wrong.
No, I don't.
One of them sort of
no,
comes
I don't.
right.
And most of my predictions,
right.
I've made a lot
Peter,
more
I let you
accurate
finish. Let me finish.
But
Peter,
Scott,
I let you finish. I let you talk.
Scott,
let me finish. The problem is, Peter lost all their money when they followed you with the first 99 predictions that were wrong, and when one sort of comes back around, they're broke. And the problem is that even when you're wrong, because you said that the Fed couldn't raise rates, wouldn't raise rates, and QE4 would be next, you can't, you're not admitting that you're wrong. And the worst decision that anybody can make when they're investing or trading is to not admit when they're wrong. That's how you get carried out.
Have you ever told somebody to buy a stock at 19 and it went to 17? Has that ever happened to you?
Peter, that's not what you did. You told people to buy it at $1,700 because it was going to $5,000, and it's now at $10.50, down $20.
You know what?
Now
but
down
it's
$26 on the day.
Scott, it's still going to go there. So you've never bought a stock that went down before it went up. Everything that you buy goes up immediately and never goes down. Excuse me?
So, Peter, you're never wrong. You weren't wrong when you said that QE4 was going to come before an interest rate increase.
Wait a
Peter,
minute, Scott,
this is why I think you're dangerous, because you're not willing to admit when you're wrong. Traders and investors are wrong all day, every day.
Scott.
Guys,
there you go. See, that's the problem.
If I could just jump in for a moment.
You didn't predict QE 1, 2, or 3 either. Why don't you give me credit for that?
Peter, with a final question to you about gold prices that kind of wraps up this conversation that you're having. You're still taking the view that gold is going higher. As you mentioned, you're relating it to stocks that potentially they go down before they go up. How much lower do you think we could go before we start to rise again?
Well, again, I don't know. I don't think there's that much downside, because I think most of this is already built into the price. Everybody has been anticipating the Fed was going to raise rates. In fact, they thought they would have raised them a lot more than 25 basis points by now. There are still people who think there's a lot more rate hikes coming. I still believe that's ignoring the inherent weakness in the U.S. economy and the fact that the Fed is going to be back to its old tricks. It only has one game plan for recession, and that's printing money. And when rates are at 25 basis points, there's not a lot of room to take them lower. You can go negative, but it's QE4 that they're going to be relying on. In fact, Janet Yellen said so herself in a press conference a couple of weeks ago. She was asked, what are you going to do if there was a recession in 2016? And her response was more quantitative easing because it worked so well last time. Well, it didn't work well last time. That's why we're going to be right back in recession in 2016.
Peter, we got to run. Just to recap your points there, you do think that we're going to see a recession that's going to trigger the Fed to take back the action with the rate hike, maybe take us into negative territory, and that QE4 could be on the table. We're going to hold you to these predictions. We always do. We'll have you back on soon.
Absolutely
Meantime,
hold me to it.